Who will benefit the most when the Federal Reserve cuts rates this week? You may think it is people looking to buy a home, but that is incorrect because mortgage rates generally follow the longer-term 10-year Treasury yields rather than the overnight rates, which is what the Fed sets. Real estate developers who borrow on short-term to develop different projects, well, they will benefit from the short-term lower rates. But who benefits the most? Well, that will be the United States government with their massive $37 trillion in debt. Now, this is because they should be able to get a better rate on short-term debt issuance. The other concern with the federal debt is roughly 61% will mature in a little over 2 years. This puts the government in a precarious situation as they will need to determine how to best finance those debt maturities. On the current path, by 2029, the interest the government pays on their debt, well, it will be close to 4% of GDP. That's gross domestic product. It's also estimated that in the short term, a 1 percentage point cut in rates would lower interest costs by 0.5% as a percent of the current GDP. Other than the psychological advantage, the consumer will not benefit much. The reason for that is Chief Globalist Strategist at J.P. Morgan Asset Management, David Kelly, noted in a research note that the reduction in interest rates reduces household income more than what they save on interest expense. His calculation is that a 1 percentage point drop in short-term rates would be a decline in interest income for households of roughly $140 billion annually in money markets alone. This number does not include all the short-term CDs and all the T-bills that will come due in the near term at lower rates as well. I'm Brett Wilsey with Wilsey Asset Management. If you like these videos, well, be sure to give it a like or comment, and feel free to check out our other YouTube videos. And don't forget about the weekly newsletter and the latest economic news and expert analysis.